Welcome, everybody, to another episode of the Industrial Insights Podcast. Today, I have Rob Quarton of Walker Dunlop, who is a rock star in general, but also when it comes to financing for commercial real estate investors and developers. Rob and I have known each other for a long time, and we have young, growing families in the same hood, which is fantastic to see you grow and to be in the same neighborhood, and excited to see your kids go through all the same schools, and it's such a great experience.
Likewise.
Yep, and then you've had a great trajectory at Walker & Dunlop, and I really appreciate the structured buzz and your coffee and capital, like a way for you to communicate what you're seeing and like help give people guidance on what's going on in the marketplace. And that is always changing and always great to be up to speed on it. And then you have taken a role and have a great experience with NAIOP, so excited to hear more about that too. So welcome to the show, Rob. Thank you for being here.
Yeah, I appreciate the time, Justin. It really means a lot to get the invitation to come on here and talk to you and your guests, your tribe, and look forward to giving some insight. Like you mentioned, I work with Walker & Dunlop. I've been over here a little over 7 years, almost 8 years, and I focus on the financing advisory brokerage side, and we work with investors and developers to help them find the complete capital stack, starting with the top at the LP equity all the way down to a bridge loan or construction loan. More often than not, it's a development deal or a value add kind of renovation, but we also work on kind of more stabilized products, whether it's industrial, multifamily, retail, and a couple other product types. And it's a good time to have this conversation because things are dynamic, and I think their shifting momentum is building to really kind of take us in a more positive direction as we close out this year and then carry over into 25. It does. Looking at some of the data that Q1 24 of this year appears to be kind of the bottom, and things are gaining momentum anecdotally, and now the data is starting to support it. So it's refreshing.
Open up the floodgates for us, Rob. We're waiting. We're ready.
You're right. Yeah, me too.
Calling the bottom. I love it. That's one of my favorite games of the cycle. Where are we at, and how do you feel at different moments in time? I thought a good spot to start, if it's okay with you, is thinking about what you saw through the pandemic and how you made it through there, right? If we think of like it's been a whiplash experience for a lot of people, having a huge pause, having this dramatic upswing, and then a downswing, and I feel like it's because the change happened in a short period of time, it led to some of the players having to react and adjust in different ways. The past couple of years of how people have set up their properties, and just thinking through as we get through it, what are some of the main takeaways you think of people as they navigated their way through the pandemic era?
Yeah, that's a good avenue to kind of have a great conversation. Starting in 20, early in the year, I remember launching some assignments and was quite optimistic about ability to get them done. There was a large land portfolio that we launched at the time, and then there was a couple other development projects. And then I actually was getting ready to have a kid at the time in March, and then the world kind of turned upside down, and really, especially in California, things stopped for a good quarter or so. And things were unfolding. People were hunkering down. Capital markets stopped. Thankfully, there was a lot of money in the system. It's just at the time it was scary, and it caused a freeze of sorts. But as we approached the summer, things really started to thaw. And then starting probably July or August, that was one of the busiest moments of my career. It's just, you talked about the floodgates opening. I mean, the money just came roaring back. Interest rates were ultra low at the time. And for real estate, because we're so heavily dependent upon it, that just made amazing levered returns, cap rate compression, and it was quite a wild ride. And then housing, along with industrial, really accelerated at that point because people either wanted bigger houses, they were moving, families were moving around, there was remote work, and so that caused a lot of flow. And then industrial just tremendously benefited from people having discretionary income savings to buy online purchases. E-commerce really accelerated at that point because in certain states, you couldn't even buy in person. And so that all really accelerated those two trends. And then on the flip side, the recalibration of certain product types, retail and office, was accelerated. So you have one that, a couple asset classes that really benefited, and then others it just it caused a really big dramatic shift. But then from late 20 to early 22, I mean, looking back, that was one of the more dynamic periods, at least in my career. I'm not the youngest guy in the room anymore, and I'm not the oldest one yet, but I've seen a few cycles at this point, and it was a fun ride. A lot of folks benefited from it. And then, thankfully, this last 2 years, it's been more of I've heard the term, the great rate reset, where, because of real estate heavily relying upon interest rates, and then, there, in some instances, if you had a floating rate deal going up 3x in your rate, that has a big shock to the system. But, at the same time, for the most part, if you owned your property for a couple of years, that the operating fundamentals were still pretty decent. So at least at the NOI operational level, you had some good strength there. Not to say that it was easy, but that at least gave you a competitive mode or a ceiling to really ride through that tough period. And it appears now that we're going through another period of rates and lending improving. I mean, the Treasury rates peaked around 4.5 this year in June, the end of June, and now they've gone down tremendously. The 10-year Treasury it was closed around 3.80 today, and then the dominant floating rate index is SOFR, and that peaked at about 5.35, and that's already started to go down, and it appears that it's going to approach 4 next year. And so, the economy still seems relatively healthy. It's expansionary. Mild inflation, hard assets do really well in that environment, and so that gives a great backdrop as rates improve for real estate to perform pretty well over the coming years. And you saw it at the very top level, some of the big institutional money starting to take down portfolios or buy REITs, and so that all starts at the very top mega public level. It's filtering down to the large private. And then in the middle market regional trades, you're going to start to see that permeate as we end this year and next year. And so, talking to folks, it's still cautious optimism, but that's building. And then, new listings, whether it's a sale or a lease, that's starting to build momentum. And it's just, it definitely has a better environment. And 25 should be a lot better.
Get an election underway, get another rate change, and then saddle up. Something like that, yeah. And then do you get the call when a deal you worked on in a 22 deal is starting to have some challenges? When it's time to figure out, like, gosh, we need to make an adjustment, or we didn't get the traction we wanted, or the tenant blew out of this big deal or whatever, and trying to think through like how to patch it up or how to adjust it. I know I have gotten probably a half dozen of them over the past 6 months, and we've navigated through 4 of the 6. We have 2 more that we're helping people with that are just deals we sold. And so that seems like that's just as we have the growth on one side, we have like dealing with the late buyers where that NOI, like if it's deteriorating or if there's some like challenge with it. So have you dealt with any of those? Are you seeing many of those on your side?
Great question, great point. Our clients are reaching out or we're even proactively following with them. And then, that's actually been a good avenue to establish new relationships with folks to try to find solutions for some of their problems. And, we'll sit down and holistically advise them. Does the path make best sense to negotiate with their existing lender? What does it look like if they want to go refinance? And then even sometimes, we suggested maybe a sale path or a dual track process might be the best for them. And because, Walker Dunlop is one of the top financial services lenders in the country, we have some really deep relationships with the top lenders and equity providers in the country. So not only can we, access the key people at the regional level, when need be, we can get directly to the important decision makers. And we pride ourselves in giving them candid advice, even if it in the long run, it's to benefit them, and if there isn't in the short run a way for us to kind of get some business, and we want the best outcome for them. And so we went through a very detailed process earlier this year, and it ultimately came to it to do an extension. There was a pay down with the loan, but it bought them time. It made the debt service more manageable. They really believed in the submarket and the metro in the long term. It was in Texas. And they found a good outcome to give them some runway for 2 more years to let the property performance, and then hopefully the valuation of the capital markets to come back, so there's some value recovery there.
Debt service, as long as you can continue to maintain your ratios, right? I feel like that's the one of the more critical pieces on a lot of these. Yeah, and a lot of that is work where it's not deal work, right? You're just helping like patch things together, but that's part of like the client for life philosophy, where you're like, we'll just help each other no matter what. Yeah. Have you seen deal activity change this last quarter as a result of stabilization and the ebb towards more confidence?
Because a lot of our activities tied to deal acquisitions or acquiring land, acquiring new properties, with the volatility in rates, because it hasn't just been a steady up or a steady down. It's been all over.
I haven't seen you on the golf course, so I imagine that activity's been okay. Yeah.
Right? Yeah. No, still cranking away. But when there's big spikes or up or down, it causes a shock, and that's when we saw pauses to activity, because it kind of paralyzes people, for lack of a better word, in the short term. And it seems like it took about 45 to 60 days to kind of absorb the magnitude of big volatile swings. But we've been in a good environment of relatively down in rates over the last quarter. So I think that has been helpful. We talk about a lot is the amount of dry powder in the system. And so that's capital that's ready to be actively deployed, whether it's private equity capital and value add and opportunistic funds raised. There's well over 170 billion in those two sectors, and they have not been actively deploying money over the last couple of years. And so that, they get paid to place money, and that money it has a weight that needs to be put into work, and that's only gonna gather further momentum to the market as the year ends. And then lenders still, thankfully, you hear office headlines and distress, but for the most part, that's a small part of the portfolio, and lenders have a pretty healthy loan portfolio. And even talking to some over the last 30 days, the market's been improving from a financing perspective, and they're starting to get payoffs, so they've started to become more aggressive to replace those previous loans and create new loans. And so you put all those factors together, it's creating a lot more activity. Talking to some lenders, I remember about a week ago, I was talking about an assignment, and he was saying over the last 30 days, his activity is up over 30% on new deals, kind of inbound reviewing. Those haven't converted to closings quite yet, but that's the leading indicator. So, real estate deals take a long time to close. So in about 90 days, you're going to see all that start to lead to closings. And then, that's going to create kind of the herd to start to move to activate and transact, which will carry over into Q1 next year.
Very much the herd mentality. We need the first wildebeest to cross the alligator-ridden river. Yeah, and then that means deal activity for this year-end push. I figure there's less urgency of like structural changes for year-end, other than like obviously the election, but anything that's like in process now is interesting to think of. Yeah, any other like thoughts on finishing the year? I figure everybody like is very motivated to start tapping into this like new activity.
Correct. And it's usually a point in the year, though, it's just the last push that you really need to get something under an LOI or a term sheet signed, because you're right.
The clock's ticking.
Right. New Year's is going to be here before it. It's going to be, Halloween's coming up, then it's Thanksgiving, then end of the year, and then just people start to get a little bit distracted. And if you don't start to sign up something now, people start to hunker down on those key things that are in front of them. And it gets more difficult, not impossible, to get new business effectuated. But we have an major election coming up, a little bit of geopolitical uncertainty that's going on. And, one thing to do is, what type of strategies do you put in place to kind of insulate yourself from some of that volatility? And one, a couple of things that we like to suggest is if you can, always put structure in contingencies for time, whether it's a longer escrow for a purchase or maybe an extension with the lender. Something that if you need it, it's great to have that structured on the front end because stuff happens. Murphy's Law. And then whoever you're dealing with, if you can, whether it's a landlord, a lender, equity provider, now is probably a time to gravitate to best in breed, well-capitalized folks. So, in those environments of uncertainty, the best in class tend to navigate it a little bit better. So hopefully, that can help you ride. If there is a wave or something that comes up that you're not going to be knocked over from it. And then if you can, structure teams that have continuity, that have worked together. We're going through a closing right now, and the lender has their counsel, and then our client has their counsel. We tried to make sure that they worked on deals before, or that type of financing, because if they're starting from scratch and in a stressful environment or potential for stressful, that's when things can really hit roadblocks. So the much that you kind of can put those contingencies or tactics in place, it's really going to benefit you to navigate a lot better.
What a difference it makes when you have people who work well together.
Right?
And I feel like with attorneys, usually you have a great group of professionals, but also just making sure like egos or like posturing or just anything that is like outside that's friction based is like at a minimum, no doubt. And then I hang out only in industrial 99% of my time. You have a broader view to the other product types. So what are some of the big trends in each one, and like how would you categorize your book between the asset classes?
The two dominant ones the last few years have been industrial and multifamily. It's just whether it's lenders or the equity providers, those have the strongest secular themes behind them in performance. And both are going to continue to do well over the medium to long term. You have an industrial, depending on the pockets and the markets and submarkets, there's more supply issues. But, what we are still seeing, if you look at like a Phoenix or a Vegas, there's still leasing velocity going on, thankfully. And it's there's just a lot of deliveries. And then, it's amazing.
This, Rob. Yesterday, to your point, we were touring in Inland Empire. We're touring 200s. And we're in a project of 4 million feet. There's a 1 million square footer, another 1 million square footer, a 500,000, a 200,000, and like a 50. Empty, all of them. We're driving through it. It's strange seeing no trucks, no cars, and we're going to the one building that we're looking at, and there's activity. It's not like there's nothing, but it was eerie, spooky for Halloween coming up to be a huge project with nothing but like 3 security cars. And then we looked to each other and thought, I wonder who the lender is on this, and not in a way of like it's going back to the bank, but just think of carrying that loan for how long, and that's a gigantic deal. And so I feel a little of that, no doubt.
Right. That's a good point. Luckily a lot of those the bigger deals, they're put together by some pretty substantial players, and so they have the resources to probably hold a little bit longer than maybe some of the more entrepreneurial type developers. But thankfully, hopefully we look back at 24, and that seems to be that I hate to beat the dead horse, but the trough of the activity and leasing activity. People are going to start to, the Fed has started to lower rates. Economy is still doing well. Hopefully that gives users, tenants, the conviction to start maybe investing in space or new space or renewals, and that can pick up the velocity. And, looking, because we do a fair amount in Southern California, but we go all across the countries on the deals that we capitalize. A fair amount in the kind of Southwest, kind of Western areas. But a lot of the lenders and investors always look, okay, yeah, there's a lot of supply, but what's that relative to the existing base? And thankfully,
Small, yeah.
exactly, especially in Southern California. But if you look in other markets, that number is bigger. It could be 20 or 30% of the base.
Savannah or something that's like a market that was smaller to medium that had a huge supply rush. I could see,
Right.
yeah.
Exactly. But I think as we get into next year and then even in 26, industrial is still going to perform strong. The multifamily has some supply issues in certain markets, but it's still absorbing. It's just the landlords there are having to offer more concessions to get the lease up.
Yeah.
But they are leasing up and they're occupying, and then those concessions will burn off because both in an industrial and in multifamily, they're starting this year. There has not been a lot of new starts, if zero, depending on the market. And
Yeah.
so, the tenants still are occupying space, and if the economy continues to thrive, absorption will happen. And when there's no new supply, then the demand driver shifts the other way, and then the landlords get the pricing power again. And so, we're starting to see and think next year could be a good time to have a better environment to capitalize new development deals. And so I think that's one theme that's going to start to shift next year, and already starting to in the fourth quarter of this year. A pleasant surprise, another asset class that's really come back strong is retail and shopping
Okay.
centers, grocery anchored centers, unanchored center, neighborhood centers. Class A malls have done okay. Lower quality malls maybe not quite as much, but just the retail ecosystem in general has
Yeah.
really performed well. We talked about COVID earlier. Pre-COVID, retail was kind of going through a recalibration. Online e-commerce, probably built too much retail the previous couple decades, and so there was some shifting, but it has emerged. In a lot of markets, occupancies are super robust in the mid to high 90s. Tenants are expanding. Rent growth is prevalent, especially in coastal kind of California, Southern California, even other markets. And so that started to attract better capital from lenders and equity. And so that is, I would say, a close second tier of asset class that has a desirability.
Yeah.
And then they have other things like self-storage and other kind of maybe good quality hotels like limited service or strong destination travel luxury kind of hotels. Those are performing well. Office is challenging, but it does appear maybe that we're starting to go back the other way, or at least near a bottom. There's the
You need
return
a
to office.
basis reset, just like you need a rate reset.
Right.
Yeah.
Yeah, but the big question the last couple of years is, what's a natural stabilized occupancy, and nobody had a good question to that. But it appears that maybe they're getting better ideas of what that might be, and
Yeah.
then employers throughout all this, I think consensus is employers would rather have their people in the office and not. And if
Where are you right now, Rob?
yeah, I'm in the office.
Yeah. Yeah, me
Yeah.
too. Yeah.
And humans are social creatures in nature, and when you have a fast-moving environment or new teams or active in-person communication is critical. And then if you want to grow your team, your colleagues, that's another key component. It's hard to replicate that via Zoom or a conference call or whatever. But the point being is that the big corporate employers are starting to have more of a call back to office. Amazon made that big news. There's others that are. I would be surprised if you ever go back to 5 days a week, but I think around 3 to 4 is probably what people will adjust to, and you still need the same amount of office space on those days. And so I think you're going to see that over the next coming years, getting a better performance spot and kind of have a swing back up. It still takes some conviction and probably some private capital to get those deals together, but I think there's better days ahead for office properties.
You can wear your pajamas at work on Friday, and
Yeah.
we'll call it even.
Right?
Yeah. And so if that's and thank you for covering retail, by the way. That's awesome. That's a one that was off my radar for a while, And then it's been amazing to see like it have its own like a renaissance and see what asking rates are on some of these projects. And they still are in many cases like 2x what they were like not very long ago. So I've been surprised to see some of the rates there.
Yeah. Thankfully, one more comment there is that some of our clients, they own properties. The last big development boom, at least in Southern California, was probably in the early 2000s. And a lot of those initial kind of junior anchors, maybe it was like a Ross or Home Goods or something, good quality tenants, they had longer term leases. Maybe they had a 10 and then they had 3 or 4 or 5 year options after. All of those are starting to roll, and those embedded leases are substantially below market. And so, market rents have moved a lot, and there's a lot of value creation there because they're moving those tenants to market now. And you're seeing a next rung of value in the step up there that's really benefiting the landlords.
99-cent stores needs to be like $3.99.
Right. Yeah.
Sure.
Yeah. So
Deal specific, right? That's half the fun is the different strategies you can employ, and then sizing everything, and that's never ending. So what's creativity look like these days?
Yeah, on the financing side, what we're seeing a lot of folks implement potentially, if they're more attracted to a fixed rate execution, is implementing a payment of points or paying fees to buy down the rate, and then that allows them to maximize the loan and have a better debt coverage ratio. So if you paid 1% in a 5-year loan, that plus or minus, that gives you about 0.24 discount to the rate. That improves your debt service coverage ratio, and then nominally you're going to be able to push proceeds. And so that's a tactic folks are using, and you can capitalize that amount into the deal. Still gets you better net proceeds, lower debt service. It is a way of prepaying the debt service, but it allows you to get some better levered returns. And we're seeing that implemented from multifamily to industrial and all types of lenders, whether it's a life insurance company, an agency financing Fannie Freddie with a multi-deal, or even it's very popular with CMBS too. So I'd say that's one tactic.
In a variety of sizes too, like that scales as you go up.
Yeah, you could use that for a smaller, medium, or large balance loan. You can kind of implement that across the board. Another structure that we're seeing is if it is a floating rate deal, folks, and it's a new floating rate deal, that may be doing an in-the-money cap, an interest rate cap, which would be, it's how you would set the SOFR rate. And so, today it's around, 4.9%. Maybe you want to buy a SOFR cap that's at 3.5%, and that will tease your rate down. Interest rate caps have actually gotten a lot cheaper once the Fed has made the pivot and the rates are escalating. And so that could be another way to make your debt service lower. And then also, if you're using a floating rate, typically the prepayment penalty or prepayment structure is more flexible. And so if you had a medium or shorter term plan, that might be a way for the owners to either refinance or to sell it without that penalty in place.
For those who aren't interest rate cap wizards, how do you come up with pricing for that, or how does that fluctuate?
Right. It fluctuates based on interest, future trading. So, what's the movement on treasuries? What's the movement on SOFR? And so that it's a very dynamic and a very large market. You can go to third-party providers who you buy that for. Personally, I like Pinsford a lot. Chatham is another one. They have pricers you can put in there. On a 2-year loan for like a spot cap, I think the last time I priced it was around 20 basis points that you would add. 12 months ago, that might have been closer to a point. So it has, thankfully, the cost load that's added to financing, if you're required to do it or wanted to do it, it's gotten a lot cheaper because the perceived in the future the rates are coming down, and so that risk is less, and so therefore it's being priced a little bit cheaper. So that that's one tactic. Another one too that we found pretty effective for kind of medium middle market size deals is using a participating debt structure, and it's kind of a hybrid debt equity structure.
Yep.
It can go up to 85 to 90% of cost, and this would be for a value add or development deal. And then it has a pretty effective fixed rate interest only to carry out your business plan.
Yeah.
And then the lender takes a participation at the profits upon sale. One of the nice features.
Oh no, they're in the
Yeah.
game. Yeah,
Yeah.
they want to play too.
Yeah. But I mean, it gives you leverage, which is nice, and then the fixed rate during the execution of the business plan is a lot lower than you would pay for even a more traditional leverage or a bridge loan. So it doesn't put the pay current rate on the deal puts a lot less financial pressure, and so you don't have a high rate while you're trying to execute the plan. So you can navigate them. Stuff happens over 3 to 5 years, and so that's nice. And then the participation is not too high, and then the levered returns to the sponsor can be really accretive, conversely. And so if feel free to reach out to me if you want more details, but it's a really effective program we've been implementing during this rate reset environment.
Yeah, it's anything that can help with flexibility as you're underwriting and trying to size things up and figure out how do we make this work. I
Right.
feel like that's a fantastic one. And then requires the lender to have a next level sophistication and confidence in your deal going forward and in your business plan.
Mm-hmm.
Super. And then loan to values, loan to costs, loan sizings, those are changing incrementally?
They are, and really over the last 30 or quarter or so, it's been the leverage has been improving because a lot of that ties to what's the stabilized debt service coverage ratio or debt yield, and now that
That'll limit you before you hit your loan to value.
correct, there you go, because they take whatever the loan amount, the lesser of the loan amount amongst these various tests, whether it's debt coverage or loan to value or debt yield. But it has been, because even with cap rates rising, the debt service has been the limiting factor more to the sizing because rates have been a lot higher recent kind of history. But with rates coming back down, that's allowing the LTV to kind of float back up. So, on a newer CMBS financing today, for a while there it was hard when rates were higher to get much above 60% unless you had a really high cap rate. But now it's not too uncommon to get closer to 65 or 70 and still maintain a full term interest only there. But then even going across the spectrum to a life insurance company loan, which typically is kind of more moderate leverage levels, with kind of peak rates, you might have seen LTV, 50 to 55%. Now it's not too uncommon to say 60%, maybe even 65, depending on what the NOI sizing kind of looks like. So you are in an environment where leverage is starting to go back up, rates are dropping, good quality.
You said positive financing or positive leverage might be on the horizon.
Yeah, correct. Yeah, financing leverage, it is. So that's a good segue into what rates might be today for a good quality industrial project. Max leverage insurance company financing is probably going to be somewhere between 170 to 190 over a treasury. And so if you added that's in the mid fives rate financing, 5.3% for a good quality industrial deal. And if you're paying a 6 cap, that's some positive financing leverage there, which is can be helpful to the leverage returns. You're seeing that in multifamily to some degree as well, with the rates sometimes approaching in the mid to low fives in the current environment. And then it travels through to the other sectors too, retail, sometimes hotels, and then definitely it actually is there in office because office cap rates have gone up so much. That's a good environment there. Leverage has come up, rates have come down. For good quality sponsors and for properties, lenders are willing to compete because they want to try to get those monies out the door, and so that all around, it's a lot better than it was 12 months ago. I'm not going to say it's ever flowing, but it is, again, it's getting into an environment that's increasing. Another trend that we're seeing is from 20 to 22. Banks were like the dominant provider of real estate capital. It was close to 50% market share.
Yep.
Last year there was some trouble in the banking sector. Silicon Valley Bank, some other bank failures, and
Couple
that
of
really was a
headlines.
pullback. Right?
Yeah.
Yeah. And at that time, because their balance sheets were under distress, there was a theme that emerged that they wanted deposits if you wanted to get a new loan for them, and then it was peaking at 20% of the loan amount. That has backed off, and the banking sectors, they still, some will try to push to get that deposits, but it might be 5, 10, maybe 15% on a construction loan, but it's gone down from that peak, which helps because just real estate investors and developers, they want to put their money in their deals because they get great returns, and that's their business. They don't want to keep it in cash and give it to a bank. So it's nice to see that trend go back the other way.
Yeah, that's a great insight. I'm not that deep in the game to think about how much like you have to have in deposits, and to think that like that is its own little market, or like another term on a term sheet that you can like continue to size up and optimize. So we see land values come off their peak, and it's amazing to see how values doubled and tripled just like everything else, and have that kind of come into its own like trough, and see where people are at with buying land again. So construction loans are available, and that's its own market. Is that I gotta imagine that's gaining steam too, and like those terms are improving.
They are. We're actually I'm in the market right now on a construction kind of request. And again, that's another theme of leverage has started to come back up for a period of time, kind of in the peak kind of movement in rates. It was getting difficult to get to 50, maybe even 55% leverage on a construction loan for multi-year industrial. That is definitely creeping back up towards 60, maybe a little bit higher in certain circumstances. Banks are still available to give that financing. They're going to probably gravitate towards maybe existing clients or best in breed developers to attract that, but that's still an avenue. But what has emerged is insurance companies stepping up to kind of fill the void. Some of them have historically had a product that was a construction to a perm, where they allowed the developer to build it and then it converted to a fixed rate kind of perm loan. Now they've developed products where it's just the construction phase, called a 2 to 4 year financing, which is more akin to what the banks offered.
Yeah.
And it doesn't require deposits, which is nice, and then it's typically non-recourse or maybe just a completion guarantee. And so
I would think you would want to have a convertible to perm, but I get that also if you separate them, you can negotiate them and leverage them and have them compete separately.
Correct. Yeah. It depends on the developer profile. If it's a developer that likes to build and hold for the long term, that makes a lot of sense. Others that are more merchant in nature, where they want to build it, lease it, sell it, and get the pop, having that perm feature is not quite as important to them. Or, some people might want to capitalize on the ability once it's leased, and maybe rents are better, or just it's at that time, or maybe the financing markets is to use that future point in time to go to refinance the property and take advantage of it then.
Got it. So life insurance can open up to the merchant builders.
Correct.
Yeah, with that product. So I think before hitting NAIOP, Rob, which I think would be great to go over for a quick minute, if you are a developer now, a merchant builder, or one that's a long-term holder, or you're an acquisitions guy, and you're just thinking about how myself for success for the next, call it quarter, a couple of quarters, what are some thoughts you should have in your head as you're thinking about, before you dial Rob's number?
Yeah.
How do you prepare yourself?
A couple thoughts there. One is a kind of a sports metaphor, is to hang around the hoop. Go out there, keep talking to people, talk to folks like yourselves that have active access to deal flow. maybe dust off old deals that they looked at 12 months that didn't make sense then because they're starting to make a little bit more sense now, and stay in the flow because I just get a sense of, I've been through a couple cycles when stuff shifts, it shifts quickly, and if you're prepared to jump and you're active and in the market, you're going to be able to take advantage of that. So
It's
I think
shifting faster and faster. When you think of like watching rental rates go up, you're like, oh man, like when
right.
everybody said it's time to go, like it went. Yeah, it did not take long for like the circle to come like a full circle on that.
Yeah, it's amazing how quickly it moves. So that would be one that I would definitely be positioned for. And I'm trying to think if there's any others. That's the one that I think that comes to mind the most.
That's one action that will lead to a whole host of good like behavior and good outcomes and good just like increasing activity levels, no doubt.
Mm-hmm.
Nobody wants to be late to the party.
Right? Yeah.
Yeah. Super. Okay, that's helpful. Hang around the hoop. I love it. And with NAIOP, your NAIOP involvement isn't with boxing gloves and night at the fights. What has it been, or what's your experience been?
Yeah, it's been an amazing organization. I first got involved in the mid 2000s. Earlier on in my career, it was actually when I was at GE Capital at the time. Went through their young profession. Yeah, I know. That's a legacy name now. They're not even around anymore. But it got involved in their young professionals group, a year-long kind of leadership group, and that was an amazing connection and in training. Got some really great relationships through that and soft skills development, and then got involved with the board, their board, and then eventually moved on to get involved with the Greater Southern California Chapter Board. Been pretty involved with the Night of the
You and Tim get to spend some time together. Tim's great.
Yeah. Tim Campbell is amazing. Actually, I had coffee with him not too long ago to catch up. But and then there's been Night of the Fights, which is an amazing event that's coming up on October 10th for those that you can still get your tickets. But it's well over 1,000 people. It's now at the Orange County Fairgrounds, and it's like the premier networking and fun event to see top people in the industry, rekindle relationships, make new ones, and really have an amazing night. So that's been fun. I've been involved with that for the past 10 years. And then the last 2 years, I've moved up to be part of the greater kind of executive board and helping kind of guide the various kind of groups and functions and working with the good leadership group that's put in place there. But it's no better organization, particularly for industrial and office. There's other product types too that are involved, but the opportunity to network with folks, get good relationships. It's very active on the legislative side, particularly for industrial right now, and what the state sometimes, or even federal laws that they're trying to put up roadblocks for us in our industry. But it's an amazing experience, and encourage anybody to get involved, and happy to answer any questions if folks want to learn more about it.
Yeah, I love how when you have a new part of your business that you're excited about, that you're learning to wanting to grow towards, I feel like that's such a fantastic organization where you can link up with people that are over in that area that you're looking to migrate to, whether it's career-wise or even if it's just your book of business. Like you're looking to do more stuff in a certain area or a certain size segment. Like there's someone there that you can connect with. I've always really appreciated that and found it helpful. And on our team, some of our guys are also like really appreciating the organization and just ability to connect with people there. That's great.
Exactly.
Cool. I think that's it for today, Rob. We hit the high notes. Is there anything we missed? Anything that's on your mind that you're like, oh gosh, how did we not talk about that?
Right. Yeah, I appreciate the time. It was a good conversation. Talk about the various segments of the market and the momentum it's building, the optimism, and then if folks are ever interested, our team puts together a monthly newsletter, the Structured Buzz. It gives us the trends, some insights, usually a cool chart or two on what's going on in the market. So feel free to reach out to Justin or myself, and we're happy to share that with you.
Yeah, your LinkedIn is great for that, and then I love the podcast that you guys put out. Those are great ones.
Yeah,
and
the Walker webcast.
Yeah, I love getting Peter in there, and Peter's a take on things and playing good cop, bad cop, and just the fun banter and healthy, kicking around of ideas of what the future holds, and trying to handicap what's going to happen. That's always a spirited debate, and I always really appreciate that and share that with a lot of people.
Exactly. Yeah, it's some good lessons, and it is entertaining.
Yeah, Rob Quarton, Walker and Dunlop, thank you for joining us.
Thanks,
Have a good
Justin.
one.
Take care.
Yep, bye-bye.